At the start of 2026, about 75 million Social Security recipients got a raise. The Social Security Administration called it a 2.8% cost of living adjustment. The checks went up. That part was real. But a lot of retirees opened their January statements and thought, that doesn't feel like what I was expecting. For the average retired worker, the official increase was about $56 a month. $56. On paper, that's what the raise looked like. What happened to it before it actually arrived is the story. To understand what happened, you need to know one thing about how Medicare Part B works. Part B covers doctor visits and outpatient care. Most people pay a monthly premium for it, and for the majority of retirees, that premium isn't a separate bill they write a check for. It's deducted automatically from the Social Security payment before the deposit ever hits a bank account. Medicare.gov confirms it. Most people have their Part B premium taken directly from their Social Security or Railroad Retirement Board benefit payment. That matters because it means the premium is a first claim. It comes off the top. Before the retiree spends anything, before any choice is made, the premium is already gone. So when the premium goes up, the raise meets the increase on the way out the door. In 2026, the standard Medicare Part B monthly premium rose to $202.90, up $17.90 from $185 in 2025. The first time the standard premium has crossed the $200 line. That $17.90 looks small next to the news headline announcing the 2.8% raise. But place it next to the actual dollar amount of the average retired worker's increase, and the picture changes. The average COLA increase for a retired worker in 2026 was $56 a month. The standard Part B premium increase was $17.90 a month. That $17.90 equals about 32% of the $56. 1/3 of the average raise, absorbed by the Part B premium increase alone. Before groceries, before rent, before utilities, before prescriptions, before anything else in the monthly budget. The raise went from $56 down to $38.10 from that one automatic deduction. That's the math. Clean and official. The SSA number and the CMS number sitting next to each other, doing something the letter announcing the raise never mentioned. And that's only the standard version of the story. For some beneficiaries, the picture gets significantly more complicated. Here's something about Medicare Part B that most people don't think about until it applies to them. The $202.90 standard premium isn't what everyone pays. Some enrollees pay more, based on their income from 2 years ago. The extra amount is called IRMIA, Income-Related Monthly Adjustment Amount. It's an add-on to the standard premium, and it's based on modified adjusted gross income from a prior tax return. For 2026, the first IRMIA bracket kicks in above $109,000 of modified adjusted gross income for individuals, and above $218,000 for joint filers. If income from 2 years earlier sits above that line, the first income-related surcharge adds $81.20 a month on top of the standard premium. That brings the total Part B monthly premium to $284.10. The $81.20 surcharge is larger than the entire average COLA increase. For someone in that first bracket, the Part B premium increase alone doesn't just absorb the raise, it exceeds it. Now, most people don't pay IRMIA. CMS says income-related adjustments affect roughly 8% of people with Part B. 8 out of 100. So the majority of beneficiaries deal with the standard premium only. But for those 8, the monthly math is fundamentally different. And the higher a beneficiary's income tier, the larger the total premium gets. At the top income tier listed by CMS, the full Part B monthly premium in 2026 reaches $689.90. That's not where most people are. But the latter shows how the Part B cost can look very different depending on where someone's income landed 2 years earlier. And the income-related mechanism isn't limited to Part B. Drug coverage through Medicare Part D can also carry income-related adjustments. CMS lists 2026 Part D income-related add-ons ranging from $14.50 a month to $91 a month, depending on income tier. For a beneficiary above the income threshold, the surcharges on both Part B and Part D can add up to an amount that makes the COLA feel like it arrived and then disappeared before the month started. Here's the more important question. Not how much the premium costs, but why this keeps happening. Why does a raise that was officially announced, officially real, and officially confirmed end up feeling so thin by the time it reaches the monthly budget? The answer is that the COLA and the monthly feeling of the COLA are measuring completely different things. The Social Security Cost of Living Adjustment is calculated from an index called CPIW. That's the Consumer Price Index for urban wage earners and clerical workers. Every year, the SSA compares the CPIW from the third quarter of one year to the third quarter of the next. The gap between those two readings becomes the COLA. The Bureau of Labor Statistics defines CPIW as a measure based on households where wage or clerical work is the main income source. That group represents about 30% of the total US population, which means the COLA isn't calculated from what retirees actually buy. It's not a retiree-specific inflation measure. It's a legal formula tied to a worker-focused index, measuring a specific window of time. It's designed to protect purchasing power in a general sense. It's not designed to guarantee that the net monthly check, after Medicare premiums and everything else, will feel bigger. The raise is real, but the raise is gross. What lands in the bank account is net. So the raise, already down to $38.10 after the standard Part B premium increase, still has more pressure ahead of it. The Part B premium is owed every single month, not just when someone uses the coverage, not just during months with doctor visits. Every month, just for having it. At $202.90 a month, the standard Part B premium across 12 months is $2,434.80. The 2025 to 2026 premium increase of $17.90 a month adds $214.80 over the year. That's the size of the annual erosion just from the premium movement alone. And the premium isn't the only Part B cost that moved. The Part B deductible for 2026 is $283 for the year, up $26 from the $257 deductible in 2025. The deductible is annual, not monthly. But it's one more cost that moved in the same direction at the same time, adding to the gap between what the COLA letter promised and what the annual out-of-pocket picture actually looks like. Meanwhile, the cost of living didn't stand still after the 2026 COLA was set. The COLA was calculated from a specific time window that ended in the third quarter of 2025. But inflation didn't stop when that window closed. As of May 2026, the Consumer Price Index for all urban consumers, a different and broader measure, is up 4.2% over the prior 12 months. Food is up 3.1%, shelter is up 3.4%, medical care services are up 3.6%. These numbers aren't from the COLA calculation period. They're what prices are doing right now, today, while the $38.10 remainder of the raise is trying to stretch across real costs. The COLA and current inflation are running on different clocks. An AARP survey of adults 50 and older, published in May 2026, found that 69% say prices are rising faster than their income. The monthly math and the lived experience are describing the same problem. The same survey found that 61% of adults 50 and older say the average Social Security monthly payment of around $2,000 isn't enough to cover expenses. After the 2026 COLA, the official SSA average for a retired worker is $2,071 a month. And more than 6 in 10 adults 50 and older are already saying an amount in that range isn't sufficient. The gap between the official number and the felt reality isn't a perception problem. It's a math problem. There's one more layer that quietly affects some beneficiaries and is worth understanding mechanically. Social Security benefits can become partly taxable depending on other income. The IRS says that if half of a beneficiary's Social Security benefits plus all other income exceeds $25,000 for a single filer, or $32,000 for married filing jointly, a portion of those benefits may be subject to federal income tax. This doesn't apply to everyone. Individual income situations vary widely. But it's another mechanism by which the gross COLA increase and the net monthly feeling can diverge, for beneficiaries whose total income picture crosses those thresholds. So here's the full equation. The headline raise for the average retired worker was $56 a month. Real. Official. Confirmed by the SSA. The standard Part B premium increase takes $17.90 of that immediately. That leaves $38.10 before anything else moves. For beneficiaries above the first ERMI-A income threshold, the additional $81.20 Part B surcharge is larger than the entire original $56 raise. The net benefit can actually feel smaller than it was before the COLA. Then comes current price pressure, running at 4.2% annually. Food, rent, medical costs, all of it chewing on what the COLA left behind. And for beneficiaries whose total income crosses the IRS thresholds, a portion of the benefit itself may be taxable, narrowing the felt increase further. The gap between the headline raise and the lived raise isn't a misunderstanding or a mistake. It's a structural gap baked into how the system works. The COLA is calculated gross. It's announced gross. But life happens net. That's not an argument that Medicare is bad or that the COLA is dishonest. Medicare is real coverage. The COLA is real protection. But the system wasn't designed to deliver the headline number as spending money. And understanding that gap is what lets a retiree or a family member plan around it instead of being surprised by it every January. The raise is real. The raise is just not what it looks like on the announcement letter. If you want to understand more about how the monthly check actually works, the mechanisms, the thresholds, the math that sits between the official announcement and the felt reality, this channel covers it all, in plain language with the numbers laid out clearly. Subscribe, and the next explanation is already there.